Okay, let's record. Okay, everybody, welcome. Excuse me, it's October 10th, 2018. We're going to do hopefully a very quick webinar on mortgages, financing, residential lending, all of that. So I want to make it a very, more of a 30,000 foot view, but with some real details you've probably never seen before. Some of the stuff that we see on the inside as loan officers, as mortgage lenders, that you've probably never seen before. So hopefully you find this informative. You learn a little bit about the mortgage industry and how important it is to real estate. That's the one real key, is the two are really tied closely together. And a lot of people make the mistake of just thinking, well, the mortgage people, they do their thing, and then I get a pre-qualification, and then they come over here and I do real estate, and we all get paid, and that's great. That's true, except there are some nuances to it that make it very, very important and can really change the game when it comes to affordability or a lower payment, or why people pay what they pay, why they pay what interest rate they pay when they might have seen something advertised that's a little bit better. So I'm going to give you a 30,000 foot view, and then I'm going to take you down to about a 1 foot view and show you some real intricacies of the industry, and hopefully you come away with a better knowledge of residential lending. So with that, let's go over a couple reminders. If you have a question, go ahead and type it into the chat room. I'll go ahead and see it. I've got to mute everybody just because it becomes a little too crazy when there's all sorts of people talking and chatting and things like that. So the chat room is right there. I think you guys can see the button. Just type in your question and I'll stop and address those questions as we go. We're going to make this very Zen-like, so very free-flowing. Ask questions. You can ask about the weather. You can ask about seagulls, their life expectancy. I don't care. We'll make it up as we go, and have a little bit of fun with it. So, but I am going to try to limit it to about an hour and 15 minutes or so. There's a lot to get through, so let's hopefully we can do that. I think we can. Okay, so let's dive right in. Overall, I'm just going to kind of go on a little diatribe here about lending. So residential lending is effectively set up here in the United States to really promote home ownership. And it's a whole different level of lending when it comes to home ownership versus commercial lending, apartment buildings, 5-plexes and above, and things like that. So 4-plex and below, 4-plex, 3-plex, 2, 1, any of those units are residential lending. And the lending system is backed by Fannie Mae, Freddie Mac, FHA, VA, and USDA for country homes, so to speak. And they all have different parameters, but effectively they're backed by these government and quasi-government. I say that because Fannie Mae and Freddie Mac are effectively quasi-government institutions. You can buy stock in them, but as we've seen from the mortgage meltdown 10 years ago, they cannot fail. Even when they're about to fail, they just can't. So the government's not going to let them fail because they basically are buying these mortgages back from the lenders that are originating them, and the lenders make money on them. So again, the 30,000 foot view is it's a little bit crazy if you don't know it. Originators out there, whether it's a bank, credit union, mortgage broker, it doesn't matter. They're originating a loan. They're on the front lines of selling these loans, talking to consumers. They do an application. And there's a ton of regulations. I mean, the regulations are as thick as any industry when it comes to mortgage lending. And they're on the front lines, and they sell it, and it funds. They charge typically an origination point, 1% of the loan amount. And if they're a mortgage bank or a credit union, a Bank of America, Quicken Loans, Guild Mortgage, Caliber, and the credit unions as well. So a credit union in your area, they can actually, they've got different rules. And the Dodd-Frank bill allows them to charge what we call a yield spread premium on the back. So they charge origination on the front, yield spread premium on the back. The loan closes, and they make that money. But it doesn't stop there. Then they can take the loan that night, package them together into these big pools of mortgages, and they sell them on the secondary market. That's where Fannie Mae, Freddie Mac, and these entities come into play, because those entities are buying those loans by the billions. I mean, it's amazing what happens at midnight when you're sawing logs those entities are buying back billions of dollars of loans from Wells Fargo and Quicken and Bank of America and everybody, and then redistributing that money back into their account. So they sell $1 billion, and they typically they'll make half a percentage point or a percentage point. It depends on what the interest rate is. So that's when, if you ever wonder why Quicken Loans charges so much, you can go to some other lender and they're charging for a 30-year fixed loan, they're charging 4.625%. And you go to Quicken and they're charging 5.25%. That's about what it is today. That margin is what they're selling on the secondary market. And in that margin, there's maybe 2 points. And think of that, 2 points on $1 billion is, it's 1 point is 110, $20 million. So they make that every night. So that's where the bulk of money is made in lending. A lot of people think, oh, they go to their corner bank, nice people, her name's Sharon, she gets me a loan, great, I'm happy, I paid my origination. It doesn't stop there. It starts there, but it doesn't stop. The yield spread premium comes into play, and then selling it on the secondary market comes into play, and that's why they charge a higher interest rate so that they can get that money. Okay. So conversely, what we do at K-Loans here is we don't sell on the secondary market, and we cannot make yield spread premium. So we can only charge the origination fee, which is just a flat fixed fee. So we don't make nearly as much money as Quicken. For example, typically, if we make $2,000 on a loan, Quicken or Bank of America is making $16,000 on that same loan. So that's why they're such big entities. And if you ever wonder why they're so big, why they have so much money and power, that's where it is. It's all the secondary market stuff. So that's Fannie Mae and Freddie Mac are considered conforming or conventional loans. FHA, VA, and USDA are considered government loans. And they also are sold on the secondary market, but they have different parameters, a little bit different parameters. So let me kind of go into those parameters. So we'll start with Fannie Mae and Freddie Mac. So those conventional loans typically in a traditional world require 20% down. If you put 20% down, you don't pay mortgage insurance. Great, that's nice. But that's not how it really is. You can put as little as 1% down and not pay mortgage insurance. It's actually a 3% down product. So they call it loan to value, 97% loan to value. And that's the loan amount to the value of the house that the appraisal comes in at. So if the appraisal comes in at $100,000 and you're borrowing $97,000, that's 97% of $100,000, and so on and so forth. So that margin in there, that down payment, is risk mitigation. That's what the lender needs to minimize their risk for taking this loan. 1% is not a lot. The reason they don't do mortgage insurance on 20% down is because 20%, in case the borrower defaults on the loan, is enough to cover the damages, going through court for a year, taking the house back, doing all the things they need to do to put it back on the market and get their money back. And that takes a long time. That takes up to a year to foreclose and sell it and all that. So, and there's usually damages. People are pretty upset when they leave a house that's getting foreclosed on. I mean, I've seen stuff where they pour cement down the toilets, they rip out all the copper piping. You know, all sorts of stuff can happen. So that 20% is protecting. It's risk mitigation for the lender. If they don't get 20%, mortgage insurance is something that the borrower pays, an insurance policy that also mitigates risk for the lender. If they foreclose on a house that only has 1% down, well, they've got an insurance policy that will pay for it. That difference. Now, how do you not pay mortgage insurance I'm sorry, I just saw Randy arrived. Hello, Randy. If you're paying less than 20% down and you're not paying mortgage insurance, the price is a higher interest rate. In residential lending, this is really important. Residential lending, everything that comes off of what we call par, anything that comes off of the base, if there's a difference, if you get a better interest rate, if you get a worse interest rate, if anything changes, kind of a perfect scenario, That's going to cost you points. It's going to cost you interest rate. The lenders are very smart. They know that over time, over 30 years, a higher interest rate is going to mean an extra $50,000 to them. So they don't mind paying your mortgage insurance, let's say a couple $1,000s, so that they can protect themselves, number one, and that they can also get $50,000 over the course of the loan. So to them, a higher interest rate is everything. And that's why I absolutely harp on this. We talk about K loans, what we do, which is the lowest interest rate in America. I'm not kidding you. I've done this so long, and I've set it up on the wholesale markets that K loans has the lowest interest rate in the country. And we do that for a reason. But low interest rates are not what typical lenders want. They want higher interest rates so that they can make more money on the secondary markets. So Fannie Mae, Freddie Mac, conventional loans. You can do 3% down. You pay really quite a bit higher in interest rate. You can do 5% down, where you pay a little bit higher in interest rate, or you can do 10 or 15% down, where you just pay just a small fraction more. And I'll show you the pricing. That's what I want to get into. So why don't we just dive in there, and you guys can see what pricing, mortgage pricing looks like on the back end. This is stuff you'll never see anywhere else, mostly because they just don't allow it. So if I price a loan, I'm going to look at United Wholesale. It's a big company out of Michigan. This owner, Matt's done a really nice job building this company. I've been watching him for 20 years. Start a loan, price a loan. He changed their website around a little bit. So let's take a look at their rates. Price a loan. Rates. I am already here. Come on, why are you doing this to me? All right, let's do this. We're going to go price a loan, easy qualifier. So, I didn't log in. That's why. I'm like, why is it not letting me do this? Now we're logged in. Okay, price a loan, rates. Come on, Internet. It shouldn't be that slow. Sometimes it is, depending on what they're doing out there in the bullpen. Using a lot of phones. Okay, that's not acceptable. Let's do this again. Let me go back here. We're in. Log in. Oh, come on. Huh. All right, let's do this all over again. Okay, let's go back in here. Open up a new browser. And let's start over. Marks. There we go. There we are. Now we're in. Price a loan. Rates. Ta-da! Okay. So what you're looking at here, this is a mortgage interest rate sheet that we get daily, sometimes many times a day. So you can see here where you see the time, effective date, lock hours, and so on and so forth. These changes occur. It's like the stock market. It's going up and down depending on where the bond market is going. Now what you'll see here is a list of rates and what we call price. Now this is the elite of the elites. When I talk about par, I'm talking about effectively someone with, well, let's take a look at it. 700 plus credit score, so that's their FICO score. And if they have 3 scores, we take the middle one. If they only have 2 scores, we take the lower one. And we're talking LTVs of 80%, so that's 20% down, loan to value of 80%, and a loan amount greater than or equal to $200,000. So someone who's got a 720 credit score, putting 20% down on a $250,000 loan, pretty easy. I mean, a lot of people qualify for that. They get this elite pricing. And the pricing, if you look over here, this is a 21 to 30 year lock. Now, if you don't know, you can lock any period. You're starting to hear these advertisements with Quicken Loans where they'll say, oh, you can lock on an 8-year loan. You can amortize it. That's called amortization. You can lock on a 28-year loan. So let's say, for example, you bought a house 3 years ago, and then rates are better. You want to refinance, but you don't want to start on a 30-year fixed again. Well, you can do a 27-year amortization at the better interest rate. And that's what these are showing. So this chart here is 21 to 30 years. This is 16 to 20 years, 11 to 15, and 8 to 10. The lower the amortization, meaning the fewer years you pay it back, the better interest rate you get. So our par rate is the one where we have the lowest negative, and in between the lowest negative and a positive. And this is the 30-day lock. So 15-day, 30-day, and 45-day lock. And here's the interest rate. So I go down the ladder to the lowest negative, a 30-day lock.
Where's the
That's
baby?
enough to close the loan.
Where's Lily?
There you see it right there. That's 0.37%. That negative means that's a credit to your borrower. So the borrower is going to get 0.37% times the loan amount. So let's say the loan amount is $250,000. 0.37% is $925. So they're going to get a $925 credit towards their closing costs.
Where's the baby?
Breathe that in
Where's
for a
the
little
baby?
bit, because it's a really confusing thing, but it's a really simple thing at the same time. Sometimes I've been doing this for 25 years. I kind of get ahead of myself, and I don't realize that it is pretty complicated for a lot of people. So I want you to take some time and think about that. I get a $925 credit for choosing the interest rate of 4.5%. Now, when people say, hey, I want to buy down my rate, or this interest rate cost me a point, or it cost me something, well, that's down here. So we say to a borrower, you want 4.375% interest rate on your 30-year fixed loan. What's it going to cost you? Well, there's the number right there, 0.273. So on our $250,000 loan, 0.273% is $682. I would tell my clients that if they're going to stay in this house, let's say this is a house where they're going to raise their children and they're going to grow old together, this is kind of the last house. I would say absolutely pay the $682 to get the better interest rate over the course of 30 years. It's going to benefit them. They're going to save $30,000 by paying $682 up front. So when people talk about buy downs, this is the chart we're looking at to buy down their rate, to see how much they're going to have to pay to get a lower interest rate, and conversely, going up. So this credit right here, you guys, this can increase, and it can really increase, like way up here, 2.114. So if someone said to me, if closing costs were $5,000, and they said to me, Joe, I have no money, I'm putting 3% down, and I have no extra money, I don't have a dime to my name, how am I going to close on this house? The seller won't pay closing costs. So when we talk about sellers paying closing costs, we look at what it's going to cost, and that's 2% or 3% that we're asking the seller to pay. In a hot market, they're not going to do that. So let's say they need $5,000 for closing costs. Well, I would go to this chart and I'd say, you know what, Mr. and Mrs. Buyer, there you are. At 4.875%, there's going to be 2.114% to pay for your closing costs. So you do a $250,000 loan, 2.114% is $5,285. So that's the money they would need. The lender would pay their closing costs for, like I talked about before, for a little bit higher interest rate. Now the key is that our interest rates are so low that even paying for closing costs, they're still lower than Bank of America. They're still lower than Wells Fargo. If someone were to walk into a branch, they would get a 5% interest rate today. So if by getting a lower interest rate, they can have more purchase power, or they can have a lower payment. I mean, that's pretty clear right there. A better interest rate translates into a lot more power when they're buying a house. And that's why shopping for home loans is so important. Some people think the lender's a lender's a lender, and that's not the case. Quicken Loans are pretty good about getting loans done. They can be a little bit cumbersome, but they want to get done. They're in the business, remember, of selling these loans on the secondary market. That's where they make the bulk of their billions of dollars. So they want to get loans done, but they charge a much higher interest rate. So if your client is savvy, if you guys are savvy, shop for interest rate, shop between a lender, a banker, a mortgage broker, and a credit union. You know, do those three and figure out who's got the best interest rate. We all work on the same parameters. We all have the same guidelines. We all have to adhere to Fannie Mae or Freddie Mac or FHA guidelines. So it doesn't matter where you go with, just get the best deal. Okay, so that 2.114 is what they would get back to them as a credit. They don't get it as money. They can't walk away with the difference at the closing table. This has to be used towards closing costs, and that's it. Any money that's left over, gone, vanishes. So actually, it stays with the lender. But yeah, they're not going to get that. So it's illegal based on the Dodd-Frank bill to get this credit as cash. Okay. Tips for key and question monitoring.
Caller 4 is creating
Oh, Allison, please mute caller 4. I did not see that. Well, let's just take a look. Oh, yeah, mute all. Bingo. There you go. Everyone's muted. Okay. Any other questions? I guess I should have looked down in the chat room a little bit further. Nope, I did not. Okay, so there you are. That's what a rate sheet looks like. And again, it changes every day. Now let's look at some of the products on this rate sheet. So we've got these conventional products. Again, conventional or conforming means the same thing. We have high balance. This is for markets that are more expensive. So Seattle, for example, high balance is, I believe, $424,000 up to like $550,000. So it's kind of this middle area between a regular conforming loan limit and a jumbo loan. So that's high balance. And if they have good credit, they're in the elite category. Now this is regular conventional here. If they're not in elite, if they can't put 20% down, or they've got a 699 credit score, well then they're going to be on this chart right here. And that's why credit scores are so important. I mean, think of that, 699 credit score. If they had just 1 point better in credit score, they could get that elite pricing. Now this pricing is still really good. So here, par pricing at 4.5% it's going to cost them 0.18. So that's almost nothing. I would pay that out of my pocket. 0.18%, that's $450. And I've done that before, where I've seen with a borrower, I'm like, look, I really want you to have 4.5%. I'll pay the $450 to get that interest rate. Otherwise, technically par would be 4.625. So with elite pricing, par is 4.5%. With regular pricing, it's 4.625%. That's a good credit, half a point. So that's $1,200 plus. But that's the difference in credit scores. That's why it's so important to have good credit scores. You get the best pricing on cars, on boats, on RVs, and on houses. So good credit makes all the difference. And people just, unfortunately, they're not taught at the high school level what good credit means, how to establish it, how to maintain it, and what you can do with it over the course of a lifetime to build great credit. Christine, let's see, I saw a tribal, I think that's a 184 loan. Let me see what the question is. Do the tribal credit unions offer same as typical mortgage lenders? Yes, they do, Christine. But what they do, everybody offers this, what I'm talking about. Everybody offers this in the world. Tribal credit unions have a special product. It's called a 184, I believe. It's been like 10 years since I've done one. Let me just check real quick. We're going to Google it. 184 tribal loan. Yep, there it is. So Section 184 Indian Home Loan Guarantee Program. So what that program is 100% down or 100% LTV, so 0% down. It's a high interest rate, and it's the government basically allowing you. They're taking the risk out of building or buying a house on land you don't own. So the reservation, people can't buy that. The reservation is owned by all the tribal members. It's owned by the tribe. You can't just buy the land. Like on a regular loan, you're buying the land. You're typically buying the rights below the land and above the land, and your house is on that. So with a reservation loan, you just own the structure. You don't own the land. And Fannie Mae, Freddie Mac, FHA, they're not going to lend on that because it's too dicey per their guidelines. So there's a special niche loan called a 184, and those tribal credit unions will specialize in that, most likely. I mean, doing the regular stuff that I'm talking about, they all do that. We all do that. That's really easy. Okay, let's keep moving. Bum, 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 bum. So we did elite, we did regular conventional. You saw the difference between that elite. You have better credit, you get a little bit better interest rate, but still, our part pricing at 4.625% on a 30-year fix today is fantastic. High balance, we talked about that. So in between product, in between conventional and jumbo. So if you have someone that needs a loan for $520,000 and you're in Seattle or Portland, other high expense areas, there's some little niches around, but certainly the Bay Area, you have to qualify. And if you go to high balance maps, you go to Fannie Mae, Freddie Mac, and just type in high balance areas, you'll see the different maps that it covers. Home Ready and some of these Home Possible, that's kind of, those are products left over from the mortgage meltdown if you need to refinance. And so I'm not really going to go into those because those are products from 10 years ago. Now this I want to get into. So pricing adjustments. Pricing adjustments, what this is, and again, a lot of people when they're doing a loan, they're like, oh, my Uncle Fred went down to the credit union and he got a 4.5% interest rate. I went down to the credit union a week later and I got a 4.875 interest rate. What gives? What are they doing? Why do they hate me so much? Well, they don't hate you. It's just numbers. And Uncle Fred's got better credit and he's putting more money down, and there are adjustments made to that par pricing that he benefits from that the other borrower, it hurts them. They don't benefit from this because I'll show you in these charts. So that's why credit score is so important. If you have a 740 and above, and you only put, these numbers up here are the LTV. So if you're putting 20% down, you're in this category right here. And if you have a 740 plus credit score, they only charge you half a point, 0.5. But if you have a 642 credit score down here, then they're going to charge you 3.75 on your pricing. That's not on interest rate, but it's on pricing. And I'll show you how that affects pricing. So 3.75 points I have to get out of my chart, my pricing chart. So that person would be right here. I don't know, there we go. So I don't know if you guys can see this or not, so I'll just get a little bit bigger. I need to find 3.7 points on this pricing chart. So I go up the ladder, and holy moly, I almost have it at 5.5, but truly at 5.625 on a 30-day lock, I can find my 3.75 right there. So that's when, if they have a 642 credit score, that's when I go, that's your interest rate right there. Does that make sense? So again, ask questions if you guys have them. I know this is confusing. Numbers get a little bit goofy, so I'm going to kind of try to back off the best I can and just keep it real simple. But that's what we call mortgage pricing. And that's why some people get a better interest rate over other people. The rate's not very good. It's because they have bad credit. There's other factors involved too. So let's go back down to our pricing adjustments. So let's say they're cashing out on a refinance. Well, those are going to be even more. They're going to add, see that 2.625? They're going to add that to the 3.75. Again, these are risk mitigation factors. and you'll see that like non-applicable or these gray areas here, they don't even lend on those scenarios. And then there's other factors here. It could be home ready loan. It could be an adjustable rate mortgage. It could be a 5-year or 7-year ARM. There's going to be adjustments made 0.00000 until you get to 90% LTV. And then there's a quarter point. If someone says, I want to do an ARM and I want to put only 4% down or 3% down, not applicable. You can't do that. But if you put 5% down, you can, and you're going to get adjusted 0.25% to your pricing, which will ultimately affect interest rate. And then there's state adjusters. So you see these states here, Minnesota and Colorado, investment properties. If it's this one comes up a lot. So if it's a duplex, and they're not living in it. So if they're living in it, it's not an investment property. They can live in a fourplex, live in one unit and rent out the other 3, and they'll still get as good a pricing as you would on a normal home, a single family residence. But if they're just buying it as an investment property, well, they're going to need to put right here, 15% down, and they're going to take a 4.125% hit to their price. So if we were to go back up here to conventional pricing, so I'd have to go all the way up here, back to 5.625% interest rate to find that pricing adjustment. Okay, let me check questions on that. No more questions there. Let's keep rolling along. Rolling, rolling, rolling. Get those doggies rolling. Okay. And all this other stuff, subordinate financing, credit score adjustments, and things like that. So when we price a loan, there's a lot that goes into it. We don't just go, okay, this is what your price is going to be. But then we can. So let's go back here and let's price a loan on an easy qualifier. Okay. So we can put in the parameters here and it'll spit out a price. So let's say example is going to borrow. Oh, look at that. I guess I've done this before. Example is going to borrow $250,000, sales price of $312,500, 80% loan to value with a 760 credit score. Borrower paid a 30-year loan, but I could change that to 25. So these flex terms right here. So I could go all the way down to 28 years. So when I'm talking about amortizing over a specific period, we can do that right here. But for this example, let's just do a 30-year fixed. Get rid of 25. 30-year fixed is it's got good pricing. It's usually the best way to go. This is going to be in Spokane, or we can do it in Tacoma, Washington, for one house. And 760 borrower paid, documentation full. So they've given us all the documents we need, tax returns, bank statements, all that stuff. Okay, let's get a quote. Okay, here's our best option. Conventional, I don't know what product perks is. I don't need to read that now. So here are our rates. Here's our ladder. So we've gotten to this adjustment. You can kind of see dollar amount is what it's going to cost or the credit they're going to get, principal and interest, mortgage insurance. Okay, so there's no mortgage insurance there, and there's their payment. Remember, their payment here is going to be principal and interest. When people talk about their total payment for a loan, it's principal, interest, tax, and insurance, and possibly mortgage insurance. So those 5 factors come into play. But typically we call it PITI, principal, interest, tax, and insurance. That's going to be their overall payment. And then the tax gets distributed and the insurance gets distributed to the insurance company and the government through escrow every month. So you just make a payment, of $2,000 a month. Well, your $300 tax payments going to county and your $60 a month insurance payments going to Allstate. So everything's getting distributed when you make your payment. So we go down the ladder, And we can see that at 4.5% in this scenario, it's going to cost $325, and their payment's going to be $1,266.71 a month. But let's say they don't even have $325 to bring to the closing table. Well, then at 4.625% interest rate, they're going to get a credit of $1,245, and their payment's going to be $1,285. So almost $20 more a month. So this gives us those options. Now, if I go back and I say, oops, they missed a payment, so the credit dropped to 665. Now let's see what their interest rate looks like. Okay, we don't have the elite option anymore. We only have a regular option. So our par pricing is right here, 4.875. So it went from 4.625 to 4.875 just because they missed a payment. And they could miss it on their gas card. They could miss it on their $30 credit card payment. It doesn't matter. It's going to affect them the same way. A 30-day late is going to hit their credit hard, probably 30, 40, 50 points off their credit score. That's why it's so important that they make their payments. I tell people that, look, if you've had credit issues in the past, I don't care if you're going on vacation, cancel your vacation and make your credit card payment instead, especially if they're going to use their credit card to go on the vacation. That's just not sensible. But so many people they put it out of sight, out of mind, and they forget about their payments, and they get these 30-day lates on their credit report, and then when they go to buy a house or a car, they get these awful interest rates, and they wonder, oh, I can never dig out of this hole. Well, this is how you dig out of the hole, is by monitoring and managing your credit appropriately, and then you get the better interest rates, and you can create success and wealth from that over time. They might be like, well, so what if it's $20 a month right now? Well, multiply that by 12, you get $240, and multiply that by 30 years. So, on multiple different products. And so it does affect people. Anyway, enough preaching about good credit. Hopefully you guys have it or are working towards it. But that's how it affects different loans. And so we can go in here and I could do, okay, loan amount 312. Let's do a loan amount of 300. Okay, now I'm at 96% LTV. Let's see what kind of products we get with this. And so you guys know LTV is loan to value. CLTV is combined loan to value. So if you have a first and a second mortgage, you combine them for your loan to value, your final combined loan to value. So now we got to get into the government programs. It's Home Possible Advantage 97 LTV, 30 years fixed, lender paid MI. So now let's look at these rates. Off the charts practically. It is off the chart. It's literally off the chart. It's above 6%. And so when they say lender paid MI, the lender's paying the mortgage insurance. If I do, let's see, borrower paid, okay, I've got them both in here. So the lender can pay the mortgage insurance. They're just going to charge a higher interest rate to do that. If the borrower pays the mortgage insurance, they'll get a lower interest rate. So you can see as we go up to 97%, it becomes almost cost prohibitive, an interest rate of 6.25%. So that's why you want to be really careful about credit. So if you have a credit, let's go back to 740, and you want to do the same scenario. And then, yeah, we're back into normal interest rates, kind of. So we've got par really right at 5%. So at 6.25%, they were gonna get this loan with a 640 and above credit score. What was it, 660? I forget. But now it's 5%. So now you see this huge difference in interest rate. They're talking almost $200 a month. It would have been $200 a month difference in payments on this loan just because their interest rate, because they missed a $30 credit card payment. So anyway, hopefully you guys get the idea. Let's check on questions. Chat, chat, chat. No chats. Okay, we are humming along, everyone. Let's everyone take a break, sip some tea, and make sure we are covering ground. Okay, government loans. So let's go into government loans. Oh, just to finish on conventional and conforming loans, less stringent uh, appraisal requirements. Not a whole lot. They can still call out a roof, they can call out mold, they can call out things that they see, but it's not required in the loan. So an appraiser is going to basically look for certain things if it's a certain type of loan. But they usually do that when they're FHA or VA. They're looking for cracked windows, peeling paint, no flooring, some real issues, big issues. It would have to be like a roof would have to be really bowed and bent and shingles falling off of it for a conventional appraiser to call that out. But they could. Again, the appraiser is the eyes and the ears of the lender. They're working for the lender. The borrower pays for it, but they're working for the lender to ensure this investment the lender's going to make by lending money. The inspector are the eyes or is the eyes and the ears of the borrower. So when they buy a home, the inspector is on their side. But when they're financing it, they need an appraisal so that the lender is protected. Okay, government loans. Let's go back into our pricing. I'm going to go back to our rate sheet. So before I get into the rate sheets, let me just talk a little bit about government loans. So government loans are a little bit looser. So they're a little bit tighter on the appraisal side, but the parameters are a little bit looser. So for example, a conventional loan requires a 43% debt to income ratio. What that means is that 43% of their entire income, if their income is $10,000 a month, they can only spend $4,300 on all their debt, their house, their car, their credit cards, their student loans, all of that. We call that back end ratio. It's all of their debt. So 43%. Government loans will go upwards of 55%. In fact, there's technically no limit. Though I've seen them go up to about 55% on FHA or VA, depending on qualifications. But so they can spend upwards of $5,500 a month versus $4,300 a month. So there's more flexibility there. And then the other side of it is that the credit scores go down. So at United Wholesale, they won't do any conventional loans that are lower than a 640 credit score. They don't even look at them. Stearns and Quicken, I believe, they go down to 620. Some will go down even below that. They just charge a whole lot more in interest rate or require more down. But FHA will go down typically to 580. So a 580 credit score, and that's not a good credit score. You've missed a lot of payments. You got messed up credit. FHA will still finance that. And FHA also only requires 3.5% down. So, and VA is 100% financing. They don't require anything down, and there's no mortgage insurance. So VA is the best loan out there by far. Sometimes you hear people like Dave Ramsey, I guess he talks about financial stuff. He doesn't like VA loans, but I don't think he knows them very well. Because a VA loan is a fantastic product, and the veterans that get them earned them. They should get them. I love doing VA loans. Oftentimes I will talk to veterans and I'll do them for free just because I guess I'm a Gold Star son, something like that. My father was killed in Vietnam. So I have a soft spot for veterans that served. And this is such a fantastic loan. No money down, no mortgage insurance, and the lowest interest rate that you can get. And I'll show you those interest rates. But if you didn't serve, you're not going to get that loan. And there are some other qualifications. You have to serve a certain amount of time, 2 years, and you have to be honorably discharged. So if you're dishonorably discharged, you're not getting a VA loan, so you didn't earn it. Now, I have seen some people discharged honorably a year and 11 months. So they did not get their loan because they were that shy. We even fought with our local congressperson about trying to get them an exemption, and it still didn't happen. So welcome to government. But anyway, so a veteran's loan is great. An FHA loan is pretty good too if you have bad credit and you only have 3.5% down. Now, the worst thing about an FHA loan, the worst thing is mortgage insurance. Mortgage insurance is on that loan for the life of the loan. Think of that, 30 years. So even if they've paid the loan down 50%, if they're in the final 10 years of the loan, they're still paying hundreds of dollars in mortgage insurance. And this was one of the real faults of the Dodd-Frank bill. I mean, the laundry list of the faults of the Dodd-Frank bill are long. I mean, I would need a lifetime to vent my frustration at the Dodd-Frank bill because it is really flawed. I know they were trying to protect the consumers, but ultimately it failed in doing so. It once again protected big banks and left the consumers a little bit high and dry. And this is a good example of that. Why should someone who's struggling have to pay mortgage insurance for 30 years if they paid their loan down and it's a secure situation, meaning the risk mitigation has gone away? So, if there's 50% loan to value, they don't need to pay mortgage insurance. If they have to foreclose on that loan, they're going to get a house back that's worth a lot more. In fact, the lenders would make a lot of money on that. So, and that's probably why they did it. I mean, again, the legislators don't write legislation anymore. The political action committees that represent Bank of America do, and that's why we have that rule. So FHA is mortgage insurance for the life of the loan. Sorry about the soapbox. I just had to go off there a little bit. But FHA is mortgage insurance for life, the life of the loan. So that's why I try to avoid it at all costs right now. I'm hoping that piece of it gets repealed. I'm hoping that, people that have a hard time or down on their luck but can just barely afford this house don't have to pay mortgage insurance 10 years down the road. Now let's get into the nuts. Oh, I didn't go into USDA. Before the nuts and the bolts, let's talk about USDA, United States Department of Agriculture. So these are loans that are 100% financing, and they're typically outside of metro areas, but not that far outside. Again, McMinnville in Portland is USDA country. Kent, Covington is USDA country, and I think Duval maybe in the Seattle area. Spokane is 57th on the South Hill. So they actually have city sewer, plumbing, electricity. It's just a normal neighborhood on the South Hill, and everything south of 57th is USDA eligible country. So people buying those houses are eligible for 100% financing, and they didn't have to serve in the military. So you can see a USDA map if you just Google USDA eligibility map. You'll see the maps, and it's very specific to streets. So like I say, 57th in Spokane or Kent Covington in Seattle, you get down into that area and there's a street where it just stops and starts for USDA. So if you have clients that, let's say, for example, they don't have any money down and they have literally zero money, they've got 20 cents in the bank. Well, I can find them a house in USDA country or VA loan if they're serving, but I can find them a house in USDA country, and I can use this rebate that I'm showing you here with the lender to pay for the closing costs if the seller won't. We always ask that the seller pay the closing costs, but if they say no, there's another way to finance the closing costs, and that is through interest rate at the lender level. And I've done this before with people that have zero money in their pocket. It's like, great, let's find you a house in the USDA eligible areas, and we'll have the lender pay your closing costs. You're going to pay a higher interest rate, but you basically get into a house for free. So as long as they can afford the payments. So there's a lot of power in some of these programs, but you have to understand the programs in order to go out there and make more real estate sales. Again, think of that. You guys probably all know somebody that has no money down and is okay living in kind of the countryside. And we're not talking hardcore country where they got to churn their own butter and drill their own well. Sometimes they have to drill their own well, but we're talking areas that are right outside the metro area and are still tied in as basically what suburbs used to be, suburban. So if you've got a borrower that has no money but wants to buy a house, look into USDA, check out the eligibility map, and see if they qualify. Okay, so let's get into pricing for these government loans. Conventional adjustments. Oh, let's see, lots of different pricing adjustments. It's kind of shaky because my computer, when I'm recording, it's really working overtime. I can hear it. More adjustments, more adjustments. Da, da, da. It's actually kind of freezing up. There we go. Freezing up on me a little bit. Okay. Come on, computer. I know you can do this. Okay. So government pricing. So let's take a look at this. I'll start with FHA. FHA, Fair Housing Authority, administered by HUD, Housing and Urban Development. So FHA is a good product if they have no other choices. You know, just kind of live with it, and hopefully they refinance out of it a few years later when their credit's better. But it has flexibility. FHA wants to get people with bad credit scores into houses, so that's the good part. Same deal. Now the nice thing about FHA is the interest rates are better. So then they're even better than VA. So look down here, our par pricing is 4.125%. And they get a credit on a 30-day lock of 0.207. Now this is elite. This means they have a little bit better credit score. Right here, 640 credit score. So 640 is not great, and $125,000 loan amount. So the parameters are pretty easy to get elite pricing on FHA, but 4.125% is a pretty good product. Jumbo, the difference between a regular fixed rate and a jumbo, and this goes with conforming as well, it depends on the area you're in. So Spokane, I believe, is $280,000-ish for a conforming, or not, I won't say conforming because that's confusing, a regular FHA product. And an FHA jumbo loan is above that 280 up to, I think, 380, 390,000, something like that. So obviously 380, 390 doesn't buy you very much in Seattle, so their parameters are much higher. And there's an FHA map. If you type in FHA loan limits, if you Google that, you'll get the maps per county. So it'll say King County FHA loan limits are $500,000. Spokane County or Ada County are 280, 290. So it just depends on the county. And and you should know your county. So those are good things to know. I know everyone on this webinar is in different counties. Look up your county on the FHA loan limit map. And then you'll know exactly what that is. Okay, so jumbo, same deal. It's not too bad. 4.25%. You get a jumbo FHA loan at 4.25% is great actually, considering how fast interest rates rose about 6 months ago. They started it and then they stopped about 2 months ago. So prices have really leveled off and they're stable right now. Okay, so we can also see 15-year loans and so on and so forth. Over here is VA. So a VA fixed rate for 30-year. Now, VA typically is not as good a pricing as FHA, but remember, it's 100% financing and there's no mortgage insurance. So par for VA is 4.625%, and that's just about 0.065. So they get a little teeny bit of a credit at 4.625. So if someone said, hey, Joe, what is the 30-year fixed VA loan running today? I would say at par, or par pricing is 4.625% for a 30-year fix. And then we've got 30-year FHA jumbos, 15-year FHA jumbos, 30-year VA jumbos, and so on and so forth. And down here in the corner, they give us our USDA scraps. So looks like par pricing for USDA is really 4.625 as well. So FHA is considerably better. USDA, VA are on par with conventional and conforming interest rates, right around 4.625 area with us, with K loans. Again, this is our pricing. This is stuff that, like United Wholesale, when we do their training, they say, do not show this to your clients. This is insider knowledge. So I'm sharing it with you guys so you see what a loan officer looks like and you understand financing a little bit better. Now, government pricing adjustments, there's still these state adjustments. There's Washington, Colorado, California, no Oregon. Oh, there it is. There's Oregon is an eighth of a point. Washington is 0.25. Idaho is 0.25. Alabama is 0.125, and so on and so forth. Loan amounts of less than $60,000, there's a big hit for that because they don't make any money on that. So they want to see loans above $100,000 for FHA and government scores. And they'll go down to 620 this lender. We have lenders, just a side note for FHA, we have a lender that'll go down to 500 credit score for FHA. Think of that, 500 credit score. I mean, that's if you declare bankruptcy and you file bankruptcy today, tomorrow your credit score is going to be about 500, probably be 480. But it'll take you about a month or two just to get into the 500s, and you can finance a house then, except for other parameters, which mean you have to wait 2 years FHA before you can finance a house. Conventional is typically 3 to 5 years before you can finance a house after a bankruptcy. But 500 credit score. Now here's the catch: is if your credit score is between 500 and 580, you have to put 10% down on an FHA loan. So normal FHA loans are 3.5% down, anything 580 and above. And if you have, let's say, a 520 credit score and you've got 10% down, we can get you in a loan. So the interest rate's probably not going to be great, but again, FHA starts pretty low, so the interest rate will probably be around 5%. So not the end of the world. And then some other adjusters, but government adjusters, they don't have too much. And then ARMs. I'll just kind of look at an ARM here real quick, just so you guys know. There's not a lot of benefit to doing an adjustable rate mortgage because at the end of that ARM period, it fluctuates. So if it's 5-year ARM, a 5-1 ARM, it means it's fixed for 5 years, and then it adjusts every year after that. The 1 is a 1-year period. So there's 5-1 ARMs, there's 7-1 ARMs, there's 3-1 ARMs, but you don't want that. You don't want to be worried like, oh gosh, I'm gonna be living in this house longer than I thought, and now my interest rate is going to adjust, and regular interest rates, the 30-year fixed loans, have gone up as well. So they're kind of screwed at that point. Interest rates are good enough where they want to get into a 30-year fix, and pricing's not that different. 10 years ago, a 30-year fix would be at 5%, and a 5-year ARM would be like 3.5%. So it was a huge difference. And then it made more sense. But you can see right now, par pricing for FHA Elite 5-year ARM is 3.75, a little closer to 3.625. But our par pricing was 4.125 FHA, so on a 30-year fix. So I would tell someone, look, get into the 30-year fixed. It'll be less of a headache in 5 years if you decide to stay in the house. Yeah, so those adjustments, I won't get into those. It's just too many of them. So another quick break here. Let's check questions. Let's sip our tea. Maybe even just agua. Okay. Yes, I have 2 cups. Killing the planet. But man, I was thirsty this morning. My wife has me on this diet. You guys done this keto diet? Oh my gosh. I eat like 10 eggs a day. I eat bacon, fat, pork, butter, just 0 carbs. And so she's trying to fix me in some way. So God bless her for doing that. But I'm getting really sick of eggs. I'm thirsty all the time because I eat so much salty meat. Anyway, the keto diet, it does work. I've lost like 15, 20 pounds. So enough of the personal information. Okay, where are we? Let's adjust down. Let's get this. Let's pull up our agenda. State bond programs. Let me touch base on that real quick. So the state bond programs, and they vary per state. So it's not always the same. They're kind of the same. So the state bond programs typically run on government loans. So they're FHA. I think they might be able to do VA as well, but I've only done FHA in the past. And so you put 3.625%, I'm sorry, 3.5% down. Excuse me. Welcome to breathing in asbestos when you flip houses as a young man. Talk about stupid. Oh man, my lungs. So if you ever wonder why I cough a lot and do that, it was flipping houses 25 years ago in Seattle. We just didn't wear a lot of masks. So pay the consequence. So take care of your lungs, people. Okay, back to the bond program. It's 3.5% down for your FHA loan. Well, a lot of people don't have 3.5% down. So the 3.5% is a second loan subsidized by the government, typically state governments. So a little bit different. I know Oregon's different than Washington. That's different than Idaho. That's different than Utah. That's different than Alabama. But they all have a bond program. And sometimes it runs out of money. Like this time of year, typically October, they run out of money. So they're allocated a certain amount for the whole year, and they run out in October or November, and then the end of the year they don't have any. And so you might have to wait a few months to reinitiate that loan, which, as you guys know, in real estate, that 2 or 3 months, sellers don't want to wait that. So it can be a real problem there. But if you ever run into that situation, email me, let me know, and see if we can work it out together. But effectively, the bond programs are just second loans at almost 0% interest rate. Sometimes it's 1%, sometimes it's 0.5%, sometimes it's a grant. They just give it to these people if they qualify at a certain income level. So they're good programs. I mean, there's people that really, really are struggling. They can't come up with 3.5% down. So I get it. It has helped a lot of people. I've seen them, especially single moms. It seems like I was helping a lot of single moms about 10 years ago. And I could again say to them, hey, you can live right in the middle of the city. You're not going to come in with a dime out of your pocket. We're going to get the seller or the lender to take care of closing costs. And for literally nickel, you can get into a house. And they were just tickled. They were so happy. It was so fun to watch their faces when they could move into the little house. Typically, they're very little houses because their income's not very good. But it's a house. It's home. It's where their kids are safe. So I always got a lot of joy in helping people with the bond program. Now, bond programs, depending on the state you're in, usually have to be pre-approved to do that. Here at K-Loans, we don't do bond programs in any state. So there's certain lenders. I know in Washington, they've got a list of them. Oregon does as well. And Umpqua Bank, I think, is one. And they typically will pair up that second loan with a first loan. But remember, it's usually an FHA. Oh, and the biggest thing about the bond programs that people don't realize is the interest rate is high. It's way up there. Again, risk mitigation is the name of the game in lending. And so if they have someone with crummy credit and no money down and precarious job situation, the interest rate is going to go higher. So just remember that if you ever do the bond program and they ask, well, why is my interest rate at 5% when other people doing FHA are getting 4%? It's like, well, you're doing the bond program. Okie dokie. Let's keep on trucking. Loan pricing and interest rates. Well, we've already covered that. So again, this, everyone, is loan pricing. This is a sheet, and you can see this word pricing everywhere. This is loan pricing. See, pricing, pricing, pricing. So LPMI means lender paid mortgage insurance. BPMI means borrower paid mortgage insurance. If the borrower pays the mortgage insurance, they get a better interest rate. If the lender pays the mortgage insurance, they pay a little bit higher interest rate. Let me take a quick look at that since we're on interest rates, or I'm sorry, mortgage insurance. Let's price a loan, easy qualifier, and let's look at what happens when you have mortgage insurance. So 700 credit score, borrower name is example. Okay, let's do 80, let's do 90. 90% loan to value. So mortgage insurance would typically be required, is required, but who pays it? Borrower, BPI, or lender paid, right there. So let's look at both and get a quote. So home possible, lender paid mortgage insurance. So this interest rate is going to be a little bit higher because the lender is going to pay the mortgage insurance, but they're going to get that higher interest rate. And again, remember, a higher interest rate is everything in lending. Bank of America knows it. Quicken Loans, they know it. And borrowers just don't. Borrowers are like, oh, you know what? I'll just take the higher interest rate. I mean, think of the lenders as kind of rubbing their fingers going, good, you took the higher interest rate. Because they know over 30 years they're going to make so much more money. So I try to get people into borrower paid mortgage insurance to say, hey, I know it's tough. You're going to pay upfront, $1,000 or whatever, but it's going to be worth it in the long run. So our par pricing is 4.875 with a pretty healthy credit, $1,100. So let's look at when the borrower pays their interest rate. I'm sorry, their mortgage insurance. Here we go, monthly. That means the borrower's paying it monthly. So now par pricing is 4.625. So we've got a difference of 4.875. The mortgage insurance right here. See that? MI factor is 0. We go down here, and the MI factor is $70.31 a month. But their interest rate is 4.625%. So by doing that, their payment is $1516.33 a month. If we go up here, their payment is $1488.40 a month. Okay? So you're thinking, well, hey, the lender pays the mortgage insurance and I've got a lower payment. Yeah, but over the course of time, the mortgage insurance is going to drop off on a conventional loan, and you're stuck with that 4.875% interest rate. So you're paying a lower payment by, what is it, $20, 1488, 15, 30, 35, $33 a month. So $33 a month, you're paying less by having the lender pay your mortgage insurance, but that mortgage insurance is going to drop off in this scenario probably in 5 years. So 5 years, when you get to 80% loan to value, mortgage insurance drops off. And wouldn't you rather go the rest of your 25 years on your loan at a 4.625% interest rate? I would. So that's kind of the difference. But if they have no choice, if they don't have the money to pay mortgage insurance and so on and so forth, then we just deal with it. Okay, so that was MI. We've looked at loan pricing and how interest rates work, debt to income and loan to value. I touched base on that. Debt to income, 43% for a conventional loan, 50 to 55% for a government loan, and that includes VA, USDA, and FHA. And then loan to value. With a conventional loan, you can get away with 1% down. With VA, it's 100% financing, so 0% down. And FHA is 3.5% down. USDA is 0% down as well. The reason they do one, there's not a 1% down product. I'll just touch base on that. It's actually 3% down, and 2% of that 3% is paid for by the lender. And again, what does the lender get for being so generous? Because remember, lenders are not generous. They're making money, a higher interest rate. So everything translates into a higher interest rate. If you're getting something, it's not for nothing. It's a higher interest rate. Just like a no cash loan, a no cost loan. So if someone's like, hey, I didn't have to pay anything for my no cost refinance. Well, yes, you did. You paid a higher interest rate because the lender took that rebate, took that margin, and that's what they used to pay your closing costs so that they could go on the secondary market rubbing their knuckles and hands going, ha, 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 I made more money on you than you think. So there's always a cost in lending, and the cost is always interest rate. Advantages and disadvantages. Well, we've talked about a lot of that. The advantage to a conventional loan is good. Maybe not great, but it's good. So I try to put people into a conventional loan if I can. A VA loan's the best. So obviously, if someone is a veteran, it's like, hey, you're a veteran, VA loan, fantastic. Let's get you into a VA loan. But if it's between an FHA, USDA, or a conventional, it's like get into a conventional and avoid that mortgage insurance. You'll pay a little bit higher interest rate, but it's an advantage. The disadvantage, or let's just say the advantage to FHA is going to be bad credit scores. The advantage is going to be a higher debt to income ratio, again, 50, 55%. and so on and so forth. The appraisal for FHA and VA loans is a little bit more stringent. So peeling paint is a no-no. Cracked windows a no-no. Appliances all have to work. House heating has to work. Carpeting, flooring has to be down. Some sort of flooring, so it can't just be subfloor. So they're looking for all that. It's not too complicated, but those of you that have gone through an FHA appraisal, you know. And when they when they fix the paint, they can't just scrape it off and let it fall down to the ground. Again, their concern is lead-based paint in the soil. That's not going to work. So when they scrape, they have to do it onto a tarp and dispose of it properly. So an appraiser, when they come back out to reinspect, they're going to look at the soil and see if there's any paint chips down there. So, but peeling paint's a no-no. You don't have to necessarily paint it, but you have to prime it. So I've done this before where I talked to the buyer, and the buyer's like, look, we want to paint our windows purple. Why anyone would paint their windows purple, I don't know, but hey, they love the Vikings and the Huskies. So they want to paint their windows purple. So you just say, okay, well, let's not paint all the windows purple to qualify for the loan. Let's just prime them. Let's scrape them properly and prime them. And so effectively, we're prepping the windows. We adhere to FHA guidelines, but then after you take possession of the house, you can paint it all the purple you want. So that's really what that FHA, if you ever run into that, peeling paint on an FHA loan. Disadvantages is typically mortgage insurance is the biggest disadvantage to FHA and or conventional if you're not putting 20% down. And then the disadvantage, you also pay an upfront fee with FHA, and it's a couple $1,000s. It's like 1.85%, but you also pay an upfront fee with VA loans. Now that's financed in, so they don't just say, hey, you've got to pay this upfront fee of $3,000. It's financed into the loan over the 30 years. Any questions? Oh, you guys are fantastic. We are cruising along. Okay. Using finance when you have an appraisal less than value. Okay, so an appraisal comes in at less than value. Let's say buyer's willing to sell it for $500,000. Certainly, or pay the seller $500,000. The seller wants $500,000, but the appraisal comes in at $490,000. Well, the seller doesn't want to come down $10,000. They're stubborn. They want their $500,000. The buyer, they don't want to come up with $10,000 because they think it's worth $490,000. So there are ways to take care of that. Usually, sometimes you can meet in the middle. I mean, you always want to try with your clients if you get an appraisal less than value and you're representing the buyer. You certainly want to ask the seller, hey, we got an appraisal less than value. Will you come down in price so we can get this deal done? And they say no. Okay, well, they're putting 20% down. The buyer doesn't have to put 20% down. They can say, all right, let's put 15% down, and we're going to use the other 5%, in this case, $20,000. If it's, well, 400,000, yeah, roughly $20,000. We're going to use 5% to give to the seller. So they will make up the difference with the seller. Now, 15% down, the loan's not as good, so they think. But if we go to our pricing scenario, let's take a look at it real quick. Let's go back to, let's stay here and go 80%. Conventional, 740, all these parameters look the same. Borrower paid, boom, boom, boom. Okay, if they put 20% down, let's get a quote. And 20% of 312,500, 312,500, 20% is $62,500. So they're pretty excited because they were quoted 4.625%. Okay, we say you can't put 20% down because you've got to give the seller some money to make up for the low appraisal. So let's put only 3% less down. Let's put 17% down. So we go here and we do, instead of 80, we do 83%. And we have the, we're going to have the lender pay the mortgage insurance. Get a quote. Watch what happens here. if my computer's not locked up. Boom, boom, underpaid mortgage insurance. There we go. Okay, interest rates. Aha, we are at 4.75%. So look at that. We were at 4.625% before. Now we're at 4.75%. There's not a whole lot of difference there. The payment's only a few bucks more a month, but now they've got the money. They've got that extra 3%, 312, 500, 3% is $9,375. They've got the money to give to the seller, and they can move on with the deal. And then you get the real estate commission. So we want to get the deals done so you get real estate commissions. I know it seems a little complicated. It is a little bit nuanced, but effectively there's a way to get it done if the seller is willing to, if they're not willing to accept any less money and the buyer is willing to adjust their mindset a little bit and not put 20% down, put a little bit less down, they can still have just about as good an interest rate. And certainly a better interest rate if they're using K loans, certainly a better interest rate than Bank of America or Quicken. They're still up at 5%, 5.25%. So there's always a way to get it done if you have an appraisal less than value. And the way to get it done is through financing. Okay, so bring any scenarios like that to me if it happens, if you have questions. Okay, shopping for loans and how to get the best deal for your client. I mean, it's pretty common sense. I think it's, no matter what it is, cars, credit cards, anything out there, boats, get 3 quotes. Look at it. When it comes to interest rates, not all lenders are the same. Get a quote from a bank, from a credit union, and from a mortgage broker. The difference is banks and credit unions typically have fixed products. I mean, they're still selling to Fannie Mae and Freddie Mac, but they've got fixed products. A broker can go to 20, like we can, 20 different lenders. And we can go to United Wholesale Mortgage and go, hey, you know what? You have good credit. Let's get you this elite pricing. But let's say they don't have good credit. Let's say they do have a 520 credit score, but they inherited some money from grandma, and they can put 10% down on a house. It's like, great, all right, you have a crappy credit score and you have 10% down. Let's go to this other lender. I think it's Carrington that does this one. Carrington Lending will do it for 10% down. It's a higher interest rate, but you know what? It's still a pretty good deal because they have no other options. So shop your loans, shop lenders. Make sure you've got a company that can get the deal done. A lot of people are like, hey, I deal with Fred. He's my uncle. Well, Fred doesn't always have the best products, and sometimes he doesn't have the products at all to fit your client that wants to buy a house. Remember, we're in the business of trying to get that real estate commission. So you want to get the real estate commission and you want to get the loan done. And plus you serve your clients better by showing them there's a better option. So shopping is always smart. I don't push K loans. I leave it up to people to be smart about it and to shop their loans. That's about it. If there aren't any other questions, check this out. Okay, good. So we'll wrap it up. So ultimately, I mean, this is an overview of lending, but you also saw some of the real fine points of lending and behind the curtain Wizard of Oz stuff that we do. Hopefully you learned something from this. Ultimately, it's about closing deals, making your client happy, and getting paid. So it's really, you can do all of that in financing, but when you're doing real estate, you have to understand lending in order to kind of facilitate the real estate. To me, the two go hand in hand so closely. I know other people, if they're scared of finance, if they're scared of numbers, they keep them very separate. But to me, they go very much hand in hand. And it's very important to know as much about lending as you can. So don't just go to these webinars, go out there, learn on your own by the webinars taught by other people, YouTubes, seminars. Sometimes lenders are putting on different talks and they're hosting different events. I mean, go to all of those and learn as much as you can. And if you do that, you're a better advocate for your real estate clients. And that's really what we're looking for. Okay, everyone, thank you very much. We'll wrap it up. So a brief overview of lending. I appreciate your time on this beautiful fall day here, at least in Spokane. It's beautiful. I know the Southeast, you're about to get hammered here again with rain. So please be safe if you're down there in the Southeast part of the country, and stay dry the best you can. I'll talk to you all next week. Thanks very much.